Money in a permanent life insurance policy can be tax-free, whether it pays out at death or at retirement. In this educational video episode, I'm going to answer a question that was submitted to me. I'm Doug Andrew. The question was, is there a limit to how much of my life insurance can be tax-free? So I'm going to answer that question based upon the death benefit and as far as also the living benefits while you are alive. So as mentioned, I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades. And if you've watched very many educational videos on this three-dimensional wealth channel, you will soon discover, or you've already discovered, that one of my favorite financial vehicles to accumulate money tax-free and then be able to access that money tax-free while you're alive for retirement income or college funding for your kids or working capital for business or your real estate management, emergency funds, whatever, and also to be used for living benefits, but when you die, to be able to maximize what you leave behind totally tax-free is a max-funded indexed universal life insurance contract that's structured correctly and funded properly. If it is, it qualifies to be deemed what I call a LASERFund. Now, LASER is an acronym that I've used for years that stands for Liquid Asset Safely Earning Returns. And at the end of this episode, I want you to stay with me because I want to gift you a copy of my most recent 300-page best-selling book called The LASERFund so that you can gain more understanding about how this works. So here's how I answered this question that was submitted to me. He had been watching my YouTube channel and he goes, whoa. And so the actual question that he posed was, hey, Doug, if I were to purchase a $300,000 life insurance policy or a $3 million policy, I don't care if it's $30 million life insurance policy, his first question in this paragraph was, is there a limit to how much of that is tax-free? Now, he was talking about the death benefit, so I answered that first. Yeah, it doesn't matter if you have a life insurance policy, whether it's $300,000, $3 million, $30 million as the death benefit. If the beneficiary, that is named in the policy at the time of underwriting, if that beneficiary is somebody that would suffer an economic loss by virtue of your death, which you have to do to qualify for the life insurance policy, you have to prove that there's a reason and justification for that amount of life insurance. I'm going to come back to that topic here in just a moment. But it doesn't matter if you qualify for $3 million or $30 million of life insurance based upon your income or your net worth, because you can't just take out $100 bazillion of life insurance if you don't make that much money to qualify or your net worth isn't equal to that. But whatever you qualify for, when you die, under Section 101A of the Internal Revenue Code, that is 100% tax-free. Only if you did something stupid, like as a business owner, if you tax deducted the premiums you paid into it, then you are triggering tax on the death benefit, which would be silly. You don't want to deduct the premiums that you put in because then you sort of mess up the tax-free transfer. I'd rather have $3 million or $30 million transfer out tax-free upon death than worrying about a tax deduction on the premiums I paid into the policy, if that makes sense, okay? So it's all tax-free on the death benefit. Now, I also explained that if you need to access money while you're alive, the Internal Revenue Code allows you to access that money without triggering income tax under Section 7702 of the Internal Revenue Code. Now, generally speaking, I will usually say there are 3 basic ways to access money out of a life insurance policy that has cash value in it or whatever. But there's the sad way, and that's by dying. Now, I don't recommend that one, but it's one heck of a return. I mean, if you put in 10,000 and the death benefit's 3 million and you die the next day. And I've actually had clients who took out millions of dollars of life insurance and they thought they were going to live 20, 30, 40 years. So did the insurance company, and they were killed in an accident. I had one that he was diagnosed in the 4th stage of Hodgkin's disease cancer. When we were filling out the app, he was coughing and he said, I can't get over this cough. Well, by the time the policy came back and was approved, he actually was diagnosed with this, but the insurance company approved him. He lived 13 months, but they paid out the full death benefit, totally income tax free. But that's the sad way. It's one heck of a return, but I don't recommend it. Now, the other 2 ways are the dumb way and the smart way. Now, the dumb way is to simply withdraw your money out of the insurance policy. You can withdraw what you've paid into the policy up to your basis, the total of what you've paid in, and there's no tax on that. But if you keep withdrawing your cash value, now you trigger tax after you've recovered your basis. And that's better than most investments that are taxed LIFO, because if you start to take money out, the IRS taxes you until you dip into your principal. Any interest comes out first. With life insurance, it's taxed FIFO, first in, first out. So if you put in $500,000 and you started to pull out 50 grand a year, the first 10 years, that's tax-free because you're recovering the 500,000 you put in there. That was already taxed. Only on the gain after that would it be taxable. That's dumb. The IRS says, no, you don't have to pay tax. You switch the nomenclature and you borrow out your money. And people say, borrow my own money? Why would I do that? Because there's usually 2 options. The insurance company will loan you the equivalent of your interest on that. So if you had $1 million in there, and if it's earning, let's say 10%, like I've netted, I've usually earned 11 and netted 10 on mine, average for the last 25, 30 years. And so if I have $1 million in there and I start pulling out 100 grand a year, I can borrow from the insurance company the equivalent of that 100,000 of annual interest. They'll loan me that, but that allows the insurance company to keep my $1 million in there growing and compounding, and they'll keep paying me 10%. So $1 million at 10% will double to $2 million in 7.2 years. And so my cash value keeps growing equal to or greater than the loan that I'm taking out. Now they have to charge you an interest rate. Sometimes they charge you a nominal rate like 2%, and they credit the collateral that was linked to that at 2%. But I usually use what is called a participating or index loan, where I borrow out money maybe at 4 or 5%, and I keep earning 9, 10, 11%. Some years I may not earn anything, but other years I've earned 25% and 61%. So that's called a spread loan. And that's where the money keeps growing at great rates of return and the actual interest they're charging you so that it's tax-free. See, loan proceeds are tax-free. So that's why it's the smart way to access your money. So when I answered the question that was posed to me by this gentleman, I said, yeah, you can access money one of 3 ways: the sad way, the dumb way. I prefer the smart way, and that's with 0 cost or the indexed loans, where you're actually continuing to earn interest compounding at higher rates of return than the insurance company is loaning you the equivalent of your interest. And there's illustrations of that in the book that I want to gift you at the end of this episode. So let's go back to what you have to do to qualify, because his last question had to do with, well, do you have to have a terminal illness, a chronic illness, to be able to access money out of a life insurance policy before you die? Well, he had learned about some things called accelerated death benefits or death benefit riders. And so there are some insurance companies that say, hey, if you have a life insurance death benefit, let's say of $1 million, and you are diagnosed with a terminal illness, your LE, your life expectancy, is in 6 months or a year or whatever, they will allow you to be able to access some of that $1 million death benefit prematurely before you die. So there are riders that allow you to access some of your death benefit. without having to die yet to get it. And that's called an accelerated death benefit or a rider. Yes, you can do that. Most of the time, people who have come to me, they have max funded their indexed universal life policies, meaning their cash values have grown by the time they're older to equal or exceed the original death benefit. They put in $500,000 and that doubled to $1 million. And the original death benefit required was only $1 million. So now they're self-insured. Their cash equals the death benefit, so the insurance company isn't charging them anymore for life insurance. But then that $1 million doubles in another 7.5 years if they're earning 9.6%, like I've averaged easily over the last, ever since 1980, I've averaged 9.62. So 9.6 divided into the rule of 72, your money doubles every 7.5 years. So $500,000 doubles to $1 million, $1 million doubles to $2 million. And so if you died when you have $2 million in there, they will pay out $2.1 million. They only charge you for that remaining $100,000. And so the cost of insurance goes down as you get older when you do it that way, but you have so much cash in there. If you have $2 million in there, you could access 1.8 million of that, and the remaining 200,000 will keep the life insurance policy in force until probably the day you die. Many companies will have riders on there that will guarantee no lapse. And so you can access sometimes 90, 94% of your cash value. Most people, if they had $2 million, they just take out, income of 10% payout, $200,000 a year tax-free if they live to be 120. So you can access the cash value without triggering tax. Or if there is not much cash value, but you're paying the cost of the insurance, you can actually take some of the death benefit early if you have an accelerated death benefit rider. But it's tax-free if you do it the smart way. You have to qualify, as I said at the beginning. When you apply for a life insurance policy, because it's an incredible instrument, whether you use it for living benefits or death benefits, but you can't just take out $1 bazillion of life insurance. When you're younger, you can qualify for maybe 30 times your income. If you make $100,000 a year, you could qualify for $3 million of life insurance. As you get older and the kids leave the nest, your life expectancy is shorter. And so maybe at age 60, you can only qualify for 8 to 12 times your income, but maybe you have higher income. Or you can qualify for a certain factor of your net worth, at least 1 time your net worth. So if you have a net worth of $5 million, you can qualify for $5 million of life insurance, okay? Now, these are called financial underwriting guidelines. And as you do that, there's all kinds of reasons or justification for that amount of life insurance, because you can use it for retirement planning, for estate planning, to pay estate tax if it forces you into paying estate tax if you died. It could be used for debt reduction, to liquidate debt or to pay off a business or whatever. And so when you apply for life insurance, you must prove that whoever you name as the beneficiary will suffer economically, even if it's your business, your spouse, your children, that they're going to suffer that much of an economic loss if you died. And if you can prove that, you can change the beneficiary later on if you want to a church, a charity, whoever you want. But when you apply, you have to follow underwriting guidelines based upon your income or your net worth. And are you going to create an economic loss by virtue of your death for the named beneficiary? If you can't prove that, you will not be approved for a life insurance policy. But once you get approved, the death benefit will be tax-free as long as you don't mess that up by trying to tax deduct the premium payments, okay? The cash value can be accessed tax-free if you do it the smart way. If you want to use the death benefit before you die, you must have an accelerated death benefit rider. So hopefully this was helpful. I answered that question and he asked me to do a video, so I've done the video. If you want to learn more, I would recommend you claim a free copy of this book called The LASERFund, and this will show you a lot of these things that I've been talking about. This is a 300-page book, which is 2 books in one. This side is about 200 pages. This is 14 chapters with all the charts and graphs and explanations. If you learn more by stories, you flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. If you want to learn both left brain and right brain, you can read both, okay? And here's how you claim your free copy. You simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. You must have some skin in the game. I'll cover the rest of that shipping cost, and I'll pay for the book. I'll send out a hard copy to you. There's options there to listen and learn, watch and learn. You can also register for webinars. You can even schedule an appointment to talk to an IUL specialist if you want, to see how these strategies may apply in your particular set of circumstances. But this is about you and your brighter future.